Treasuries are soaring and bond ETFs are booming, but investors mistaking safety for certainty. This is Inside ETFs, and we're talking about fixed income. Even with record deficits and rising questions about the Fed independence, US government debt remains the world's safe haven. Treasuries are up about 6% this year, heading for their best performance since 2020. And fixed income ETFs are along for the ride, promising steady income and low risk. But unlike individual bonds, they never mature, and your principal isn't guaranteed. So if safety matters, is it smarter to stick with individual bonds? Let's ask Jason England, Managing Director and Portfolio Manager at Simplify. So Jason, the US is staring down massive deficits and a mounting debt load that won't disappear anytime soon. How sustainable is this run over the long term?
It's a challenging, endeavor for the Treasury. Obviously, they've started to issue more on the front end because it's harder to roll over those longer term debt, at these higher levels. And, we can't keep kicking the can down the road. But I think what we're looking at right now with Treasuries is even though earlier this year people started to think that they were going to lose their safe haven status, we're still seeing it. We've seen some flight to quality recently. When you really seen some of the hiccups we've seen, whether it's trade tensions, government shutdowns, what have you, there's still been a bid for Treasury. So I think there's still some sustainability here this year.
Well, bond ETFs now make up nearly $2 trillion of the broader market. What's the allure of choosing fixed income funds over buying bonds directly?
I think just like with 40 Act mutual funds, people don't want to have to go handpick their own bonds and do all their own research. And I think it's easier to hire a manager to do that has the expertise, and so ETFs have now broadened the reach even more so because, they had a rule change back in 2020 where you can use the use of derivatives as well as bond picking in there. So it's really made the flexibility of owning a bond fund. Plus, you have the intraday trading ability that you don't have in the mutual fund space. So it's really brought a great demand and a flexibility and an ease of use for investors now to be able to get fixed income exposure through ETF wrapper.
Well, fixed income is often seen as a set and forget play, but without a maturity, do bond ETFs require a more active hand?
Yeah, I mean, that's the key here is I think, active management, when you've had some of the volatility we've had in the recent years in rates, you really want an active manager who's actively managing these ETFs and trading, as you said, you don't want to just, buy a bond and let it sit in there till maturity because as we started to see the Fed start to ease now, you're going to want to start, locking in some of those yields and optimizing your portfolio and take advantage of when rates are a little higher and you have the ability to manage it and extract some more yield and maximize return, active management is the way to go in fixed income.
Let's talk about rates now, and traders still see 3 Fed cuts by next September, but Chair Powell is pushing back. If room for a longer pause, do fixed income ETFs still offer a compelling story?
Yeah, I mean, it's a hard landscape to navigate right now because you have the Fed's looking through the fog right now. There's not a lot of data with the government shutdown, so they're looking to the private data. Private data, hasn't always been the best to look at. They kind of rely on the government data more. So you have that uncertainty, and that once again goes back to that active management component. So you don't want to have to be an individual investor trying to see through this where you can hire an active manager to look through that fog and try to analyze, not only the Fed, like you said, there's been a lot of pushback by Chair Powell and even a lot of the other members that have come out since the last FOMC meeting talking about this pushback and is inflation still running much above their close to 3% above their target, and the fact that they're not getting a lot of labor data. Some of the private data is looking still weak. So they got that tension between their dual mandate. So really, you want an active manager. And I think in the ETF wrapper, we can continue to provide that yield in this environment we're in right now with rates.
So finally, Jason, Deutsche Bank is saying that they're shorting the 10-year Treasury notes. Could this position gain momentum? And isn't this a worrying trend for bond ETF holders?
It's difficult to, try to pick a direction in rates right here. And so I think that, if you start to see, one side or the other, whether you're shorting or you're long, I think that's just going to increase rate volatility. But really what you're seeing right now is the volatility where it's come down quite a bit. If you look at the move index, we've got below 70. We're a little above that now. So rate volatility's come down a lot since the beginning of, well, really since April when we had the tariff tantrum. But with rate volatility lower and yield or rates try to, trading within a range, I think that's an opportunity, especially for option income in the Treasury space, to take advantage of that. So I think there's still benefits right now in the ETF space when you're looking at option income.
That was Chase in England from Simplify. Don't forget, you can watch more videos on Reuters.com.